Hi friends, welcome to Adda 24/7. We are in the Scholar series for BFM. Here we are covering all the important theory, numericals, objective questions and case studies. So watch the series till the end. Also watch all the this lectures of the series. Okay, let's start. All transactions undertaken. One sec, yeah. All transactions undertaken by a bank have one or more of the following risk. So which risk all the transactions have? All. Market risk including liquidity or interest rate risk, credit risk including default risk, operational risk, and any of the above. All the transactions, all means let it be saving, current, FD, or loans, all the transactions have one type of risk in common. Which is that? Think over it. Is it market risk including liquidity? Is market risk common to means will be there in any transaction? What is the market risk? Market risk means that risk which is not in your hands, but which might affect your business or your daily life. For example, suppose if there is a Russia-Ukraine war, okay, this market risk we are talking of. Suppose if there is a Russia-Ukraine war, this war goes on, suppose it goes on full blown, or tomorrow China attacks Taiwan, okay, something happens, or tomorrow USA attacks somebody. So that is not in your hands, but that will definitely affect your loan rates as well as your FD rates. So market risk is that risk. Credit risk including default risk. What is credit risk? Credit risk means there are two types of risk. Remember, in credit risk there are two parts. One is your country risk and second is counterparty risk. Okay. So country risk means risk related to the default due to the country's problems. For example, Pakistan or Afghanistan, Sri Lanka, all our neighbors. You call any of our neighbors, it's one and the same. Okay. And counterparty risk means that country is good, but your party is bad. Okay, means the customer or the person to whom you have lended is bad. Like this Vijay Mallya case, Kingfisher Airlines. Okay. So that is credit risk. Operational means what? Operational risk is risk related to your systems, your issues, your strikes, your let's say rain. Suppose there are huge floods, then also you have operational risks. Your link is down, operational risk. So which of these risks will affect the bank? And any of the above is also the answer. So the answer will be definitely over here. Here, any of these risks can affect your banking transaction. So it is any of the above. Okay. It can be market, credit, operations, any risk. It can be something else also. See here, we have to choose between the options given. Actually, there are other risks as well. So other risks are what? These are the three risks: market, credit, and ops. The other risks are systemic risk, reputational risk. These are also the other risks, right? So these can also affect your banking transactions. A bank branch sanctioned a term loan of 10 lakhs for a period of 7 years at 3% plus base rate of the 9% of the 9% of the bank. Okay. The funding of the loan is from a 3-year deposit at 7%. Which of the following risk is the transaction affected? Okay. So 10 lakhs at 3% plus base rate. So forget this 9. Okay. So 3% plus base rate of the bank. So whatever the base rate plus 3%. Nowadays we don't have base rate as such. Base rate is gone. Nowadays instead of base rate we have repo rate. Let's call this repo because nowadays this repo transactions have come. Repo rate plus 3. The funding of the loan is a 3-year deposit at 7%. Which type of risk the transaction is associated? Now think over it. See this. You have funded at what? Repo plus 3. Now this is a floating rate. and your funding is from what? Deposit, which is at 7%. Now look at the different aspects of this part, okay, of this transaction. Loan is at what? Repo, right? Repo plus 3. And deposit is at what? Deposit is at what? It is strictly 7, so it is fixed. So this is floating and this is fixed, right? So now what does it mean? When your deposit is fixed and loan rate is floating, what type of risk will you face? Is it funding risk? Is it time risk? Is it liquidity risk? Is it all of the above? Yeah. What can be the answer? Think over it. I'll answer this. I'm having a detailed answer for this. Think over it. Is it all of the above? D. What is the funding risk? You tell me first, what is the funding risk? Funding risk means you don't have funds at the time whenever it's required. Okay. So time risk. Time risk means again the same problem. See this 3 years. What is this? Period of 7 years, and the funding is from a deposit of 3 years. Now this is a huge problem. Huge problem. See this loan is for 7 years and this deposit is for 3 years. So what will happen? After 3 years, this person who has deposited the money, look at this, he'll come for withdrawal. Where will you have the money? The money will return after 7 years. So here you will be facing this time risk. Funding risk means this repo plus 3 and 7%, fixed and floating. If tomorrow the repo rate changes drastically against you, then you are in a problem. Similarly, liquidity also. You will be facing the liquidity risk also. See, our liquidity and funding risk will both go hand in hand. Okay. So you will be facing this liquidity risk also. So the answer will be D, all of the above. Okay. It will be D. So funding risk, time risk, liquidity risk. Got it? Everyone clear? So all the 3 types of risk will be there. At the end of 3 years, okay, I'll just summarize. Somebody is typing, kindly give it again. At the end of the 3 years, there's a funding risk, right? Because 3 years, there are no funds. The funds will be coming after 7 years. In case there is a default in return, means somebody, that loan person doesn't give you that loan borrower, doesn't pay you, then how will you pay that depositor? Okay, so that will be a default part. Okay. Similarly, this time risk. Okay. Now there is also maturity mismatch. This maturity mismatch means what? 3 years and 7 years. Now this maturity mismatch always creates a liquidity risk. Always. Okay. So all the types of risks. A branch has sanctioned a term loan. Let me see the same problem. 3 years. Which of the following is it associated? Oh. Answer is same. No, question is same, but the risks are separate. Look at these risks: funding, time, liquidity, and here it is basis, operational. So look at this, the same question. Okay. So 9% I'll remove. A branch sanctioned a term loan of 10 lakhs for a period of 7 years at 3% plus base rate of the bank. Now base rate means again the repo. The funding of the loan is from 3-year deposit at 7%. Which of the following risk in this transaction is associated? Basis risk, operational risk, reputational risk, and all of the above. Now think over it. Which of these risks? Basis, operational, reputational, all of the above. Now again, many of you are thinking, I'm seeing some comments over there, that all of the above. Many of you are typing this all of the above. No, here all of the above is not the answer. Okay. Here the answer is basis risk. Basis. Operational risk it won't be facing, because nowadays everything is computerized. Okay, it won't be facing that operational risk. Reputational risk also it won't be facing, because it's already gone. Okay. Means the loan is also gone and deposit is also, means we have received it. So the operational reputational risk won't be there in this case. But what about the basis risk? Basis risk is definitely there. What is the basis risk? The change in the rate of interest, change in ROI, right? ROI for deposit, okay, deposit and loans. Very important word now. In different proportions, in different proportions, okay, different proportions, that is very important. In different proportions, this is very important. What do you mean by different proportions? What was the case earlier? Look at this. Repo plus 3. Now if the repo rate changes, your deposit won't change over here because it is fixed, but your loan will change. So in that case, what happens? If repo goes down, then the earnings will go down, but the outgoings will be the same. That's why you'll be facing this basis risk. Okay? When the ROI of deposit as well as the loan change in different magnitudes, different proportions, then what we face is the basis risk. Okay? Same question again. Here, something is added over here. A bank branch sanctions a term loan of 10 lakhs for a period of 7 years at 3% plus base rate. The funding of the loan is from 3-year deposit at 7%. Now look at this. The question is added now. After 3 years, when the funding of the term loan would be required, deposit rate may not be the same. At that time, this transaction would face what type of risk? Now this is a future transaction given. After 3 years, here this deposit is of 3 years and loan is of 7 years. So at that time, after 3 years, so today I have given this loan. This loan is for 7 years. 7. Okay. And this deposit I have taken is for 3 years. 3 years. Now this deposit needs to fund this loan. After 3 years, I'll be again, this loan is for 7 years. So I'll be requiring the same deposit for remaining 4 years. So at that time, this deposit will go because the depositor will withdraw this money. I need to have a fresh deposit. So this fresh deposit when I bring, what type of risk will I face? Liquidity, interest rate risk, gap or mismatch, and embedded option risk. What risk will I face? That's why this question is different. Question is similar, but look at this. Okay, will I be facing this embedded option risk because this is a new risk which you are seeing? Will I be facing that embedded option risk? What is embedded option risk? Embedded option risk means somebody can withdraw the funds at any time, deposit at any time, or somebody can repay the loan at any time. So this risk is commonly there in all the transactions. It's not for specifically this transaction. Embedded option risk is there for each and every transaction of the bank. So what risk over here? Yeah, embedded option. So here I have given you the options. Okay, I'll give you one more option in this. Okay, let me see. Yeah, E. Let me give you E option over here. E option is, let me type this, C and D both. C and D. Okay, both of them. Gap or mismatch risk and embedded option risk. Both of them. Now this is a new option which I have given. Will it be facing both the options? Yes. C and D both. Embedded option risk, as already I told you, I can withdraw the funds anytime, I can repay the loan anytime. Okay. Gap risk means what? Or mismatch risk means what? Mismatch in the maturities. This is generally due to the maturities. See this, there is a maturity mismatch. So definitely C will also be there. So the answer is E. C and D both. Okay, C and D both. Okay. Liquidity risk, you'll say it is there. Yes, it is there. Interest rate risk, it is also. See here, all these transactions are faced with these risks commonly. Liquidity, interest rate. But the right answer which is required over here is gap or mismatch and embedded option. The market risk arises on account of transactions reflected in. So, on account of market risk is applicable to which book? Banking book, trading book, banking and trading book, banking book, trading book, and off balance sheet exposures. So market risk arises because of what? Yes. Okay. Let me explain you. What is a banking book? There are two types of books. In fact, three types of books. Okay. There are three types of books in banking. One is known as banking book. Banking book. Second is known as trading book. Trading. And third one is known as customer book or customer records we call it. Customer ledger also you can call it. Customer book. So here the customer transactions are recorded. This is basically the treasury part. So banking book we record all the transactions related to banking. Means mainly there are CRR, SLR, compulsory ones, whichever are statutory compliance part. Plus your saving current FDs, whatever money you get from there, these are all recorded. Only peculiarity about banking book is the bonds purchased over here are kept till maturity. The bonds purchased in banking book are kept till maturity. And in trading book, this is called as a proprietary book. Proprietary. So the bonds purchased over here are not kept till maturity. They are kept for sale. These are called as available for sale. Okay, or ready for sale also you can call it. Ready for sale. So these all bonds are ready for sale. Now whenever any bond is ready for sale, it means it will be affected by the market price. So this market risk will affect whom? Maturity bonds or ready for sale bonds. Now this is what I've made the question more simpler. Now answer this. Is this banking book or trading book? Okay, I'll give you the options. A and B only. A and B. This off balance sheet, remove it. Okay. So A and B only. Banking book or trading book. Now look at this. Ready for sale or maturity? The answer is obviously trading book. Because whatever is at maturity, that won't be affected by the market price. If I purchased a bond and I'm not going to sell it up to maturity, then how will the rate in the market affect me? Not at all, isn't it? A trading book consists of banks' proprietary positions in the financial instruments covering debt securities, equity, foreign exchange, commodities, and derivatives for trading. Think of it. A trading book consists of banks' proprietary positions. Proprietary means what? What is the meaning of proprietary word? Proprietary means business. Okay, it's business. Buy and sell. Both means I'm ready to buy and ready to sell. Business. Okay. Ready to buy and ready to sell. So debt means what? All the government bonds as well as the private sector debentures. Equity. This common equity. Foreign exchange. Dollars. Mainly dollars here. Dollar is not the only thing. There can be other currencies also, but freely traded currency is dollar. Commodities like gold. Nowadays e-gold is available. Derivatives for trading. Now look at this. Derivatives for trading. Derivatives are purchased in the banking for two purposes. One is hedging the risk. Always remember this. Derivatives are purchased in banks for two purposes. Okay. One is for hedging the risk. Hedging means what? Reducing the risk. And second is trading. Trading means profit. Okay. So here it is specifically mentioned trading. It's not mentioned hedging. Okay. So what is the option? What can be the answer over here? Yeah. It is 1 to 5 all. All of them. Okay. 1 to 5 all. A trading book of a bank is exposed to the following type of risk: market, liquidity, credit, and counterparty risk. So trading book, again remember the trading book means buy and sell. It's a business transaction. So it is subject to which? Now this is a simple one. Yeah, it is subject to all the risks, all of them. Okay, 1 to 4 all. Market risk. Market risk means, as I told you, Russia-Ukraine war, or that what China or this was Israel war, right? Liquidity risk. Already just now we discussed this liquidity. On time we don't have money. Credit and counterparty. So means the other party is not paying. So all the types of risks. Got it? This is simple one. So answer is 1 to 4 all. The liquidity risk in the trading book consists of asset liquidity risk, market liquidity risk, and funding liquidity risk. Simple one. Very simple. Yeah. Consists of what? Asset liquidity, market liquidity, and funding liquidity. Yeah. What do you think? Yes. So it is 1 and 3 only, or 1 to 3 only, 1 to 3 all, or 1 and 2 only. Asset share liquidity risk in the trading book. Trading means what? Here I am buying and selling. So is it asset liquidity, market liquidity, and funding liquidity? It is 1 to 3 all. In fact, all of them. Because if here trading book means I have to sell something. If asset liquidity means what? If the asset is not liquid, nobody is ready to buy that asset, then it won't be sold. Market liquidity. Tomorrow there is a Russia-Ukraine war and the price of the bonds fall down. Tomorrow this war increases. Tomorrow there is a China war. Price of the bonds fall down. Okay, they fell down as such. So in that case, what will happen? This market liquidity will be gone. Funding liquidity means the funds which I receive. Let it be from savings, let it be from current, let it be from any other deposit. Okay, if I don't get the funds, then what? So it is 1 to 3 all. Right? The ability to freely transact in the markets at reasonable price is called as market liquidity, trading liquidity, market making, and market movement. What? Yeah. Freely transact in the market. This is related to trading of the transactions, trading. Okay. So the answer is trading over here. Okay. Trading liquidity. Trading liquidity means I must have that much funds in my account so that I can trade freely. Nowadays we have that daily margin, right? In your, those who are doing trading in stock market, they'll understand this. Daily margin we have. This daily margin is basically trading liquidity. Okay. Now before going, let me tell you, join the batches ASAP. Okay. All the batches here. Let me show you. Go to Adda 24/7. Hold on. Always I'll suggest you to go through the app. In the app you get 1% extra using the coin systems. Okay. Go to Adda 24/7. Then click on JAIIB and CAIIB. Click on CAIIB June 24. Okay. Look at the batches. See this victory batch. June 24. Click on this batch. You will see right now the discount offers. It's 79% off. See this. Click on buy now. Put the code Y432. Y432. Click on apply. Look at this. 79% off you are getting. 79. So join it ASAP. Use discount. Plus, if you go through the app, you will be getting 1% extra. So you'll be getting 80% off. And what do you get? You get ebooks, test series, online classes, live classes, expert faculty, interactive classes, recorded videos. Recorded videos means if you miss out on any class, you can definitely get back. Limited size batches. Also you can join the Mahapack. This Mahapack you get multiple batches. See this Mahapack. Right now you are getting double validity. So if you buy for 6 months, you get for 6 plus 6, 12 months. So 6 months you are getting free. Double validity, and also offer is valid 80% off. Okay, put the code Y432. Never forget this code Y432. 79% plus 1% on the app. So buy immediately. Okay, you get multiple batches in this Mahapack. Okay, so buy from my side.